Hello, friends. Welcome to OAWA's weekly update on the economy and markets. This week, we begin news with the all important RBI monetary policy review outcome, which was announced on 10th August. As expected, the MPC or the Monetary Policy Committee of the RBI kept key policy repo rate unchanged at 6.5%. The MPC also decided, by a majority of 5 out of 6 members, to remain focused on withdrawal of accommodation. Governor Shaktikanta Das also reiterated that the MPC remains resolute in its commitment to aligning inflation to the 4% target and anchoring inflation expectations. Apart from this no change, the RBI took another significant step in the policy for reducing the excess banking system liquidity. This was the imposition of a temporary incremental CRR or cash reserve ratio of 10% on the increase in banks' net demand and time liabilities, that is NDTL, between May 19, 2023 and July 28, 2023. One of the main reasons for the recent surge in liquidity has also been due to the returning of the Rs 2000 loans to the banking system. This measure would be reviewed in September and likely reversed ahead of the festive season. The existing cash reserve ratio remains unchanged at 4.5%. After the monetary policy announcement, the stock market went up a bit and debt market yield levels were mostly unchanged. Moving on, after vegetables, cereal price inflation is now becoming a cause of concern among policymakers and analysts. After India banned rice exports following double-digit price rise, it is now being reported that wheat prices have jumped to a 6-month high due to limited supplies and robust demand ahead of the festival season. Rising wheat prices could contribute to food inflation and potentially complicate the efforts of both the government and the central bank to contain inflation. The government is considering cutting or even abolishing a 40% import tax on wheat and lowering a limit on the amount of wheat stocks millers and traders can hold. Moving on to news on listed companies, India's largest bank, the State Bank of India, has announced a record quarterly profit of Rs 16,884 crore for the quarter ended 30th June 2023. Not only was this SBI's highest quarterly profit ever, but SBI also beat Reliance Industries to become India's most profitable company in Q1 FY24. However, on first half basis and income basis, Reliance Industries continues to lead. Fall in gross and net NPAs, improvement in net interest margin were among the key factors leading to SBI's record profits. Moving on to news on the global front, the Chinese economy is fighting a rare phenomenon, that of deflation. In an era when most economies are facing high inflation, the latest consumer prices data for the period of July 2023 shows a minus 0.3% fall year-on-year in prices. Weak consumer and business demand, prolonged property market slump, plunging demand for exports, and subdued consumer spending are said to be the main reasons. The Chinese central bank is expected to cut key rates but have several constraints to face, like a weaker yuan and elevated debt levels. Some analysts feel, though, that the contraction may be temporary as it is on a high base and expect the situation to normalize soon. Finally, we end with an interesting piece of news from Europe. Italy last week dealt a surprise blow to its banks and sent shockwaves across the banking sector in Europe by imposing a windfall tax of 40% on bank profits. Analysts expect that the tax could wipe off nearly a fifth of Italian banks' 2023 net income. The government has said that the main reason is that while Italian banks have raised lending rates as key rates have gone up, but a commensurate rise in deposit rates has not been done, leaving households and businesses worse off. The news led to a fall in banking stocks in the Italian stock market. This kind of tax is not something entirely new though, as last year Spain and Hungary imposed a windfall tax too on banks and energy companies. That's it for this week from our side. Do click like, share if you liked our content, and do visit www.oawa.in for information on our courses. Bye for now.